Hi, this is John Coumarianos with Mindful Advisory, bringing you another edition of Driving Returns. What drove returns this week was inflation. We got an inflation number on Tuesday. It was 3.1%. That means inflation ran from January 2023 through January 2024 at 3.1%. Anytime you get an inflation number, it's an annual number. The numbers come out monthly, so we measure it every month, but the numbers represent an annual inflation rate. 3.1% was more than many economists expected. I think the consensus was 2.9%. Not much more, but enough to make the markets get jittery. The markets dropped on Tuesday quite a bit. For the week, they improved, but they were still down. S&P 500 was down about 0.5% for the week. It's still up 5% for the year. That's a very healthy gain for 6 weeks into the year. Foreign markets, the world stock market minus the U.S. is up only about 0.5% for the year. Still not bad, but considerably less than the U.S. market, which is carrying the rest of the world's stock market right now. Um, I think the lesson from this week is inflation is probably going to be with us a little bit longer than many people think. We may go into a recession later this year. Many people are forecasting that. Even if we do, inflation may not go away on a longer term basis. I've posted a chart here that shows inflation since 1948. Again, this is the monthly number, which represents an annual rate every time it comes out. And you can see that there were three spikes there in the 70s or up to 1981, where that circle captures that period. So inflation, once it reaches a certain rate, can be hard to bring down over the longer term. I think the Fed is acutely aware of this, and so they're not giving up the inflation fight. They're not at their 2% target. That may be something they have to give up. Maybe it's better to not have such a hard target. Maybe we have to live with 3% inflation for the next decade or so. No one really knows. It is worth noting that over the course of this whole chart since 1948, inflation has averaged 3.5% on an annualized basis. So 3% for the next decade wouldn't necessarily be a bad thing. It wouldn't meet the Fed's stated 2% target, but maybe not so bad in the grand scheme of things. Nobody should be changing their allocations in any serious way in response to this, but be mindful of the fact that inflation higher than we've had over the past 10 years, we might have to live with inflation over the next 10 years that's higher over what we've had over the past 10 years, which was an unusually low rate of inflation really over the last 20 years. So that's what's been driving returns this week. This is John Coumarianos for Mindful Advisory and for Driving Returns signing off. Thanks for watching.